Okay, welcome to another segment of mock exercise. So today we're going to actually do an exercise that will showcase the elimination of intercompany profits. And we're going to take a look at two things actually for the M and K company question. It's elimination of intercompany profits remaining for a land sale and for a machinery sale along with inventory. So that's the question for today. Now, this question, again, we're going to go through the question, but let's take a look at the required. The required says prepare a consolidated financial income statement for year 6. And then this is probably, it means they want a good format. It's not it doesn't say calculate, it just says prepare a good income statement in good format. Okay? So let's look at the question. The question says that the two companies are M and K, and these are the financial results for year 6. Okay? Now, M uses equity method of accounting for its investment of K. So who's the parent here? If there's income from subsidiary, then this is the parent and this is the sub. Now, how much does M acquired? M acquired 80%. So I'd like to just draw that in there. Of K, and the acquisition date is January 1st. Again, it's important to note this because it could be July, it could be partial year, so we need to be mindful of the amortization of the acquisition differential, particularly in the first year of acquisition. So the acquisition differential is $25,000. Again, they gave us the AD, and it was recorded entirely to building. It's amortized over 20 periods. So the AD is building, and that is $25,000 divided by 20 years. And that is $1,250 per year. Now, it says amortization expense is group under distribution expense. So this one, I'm going to write this down, includes amort. Again, I like to write that down only because when I'm starting to eliminate the amortization, let's say, or include the amortization of the AD, then I need to know which line I need to include that in the proper consolidated statement. An impairment loss, if any, are grouped in other expenses. So I'm going to write that down in other, an impairment loss are grouped in other expenses. So I'm assuming it's other admin, right? So impairment. Okay, now M made advances of $100,000 to K, so that's a downstream, and it says this is on July 1st, year 6. The loan is due on demand, and it has 12%. So we know that's intercompany interest, revenue, and expenses, right? So we need to calculate what that is. So we know that it's $100,000 at 12% gives me $12,000 of interest times 1/2 because it's half a year. Gives me $6,000. So we know $6,000 of this relates to the interest, intercompany interest. So let me highlight that. Let me highlight that just to kind of be mindful that I need to incorporate the elimination there. Now, it says that M rents marine equipment for $50,000, so that's the rent. And it's part of the admin expenses, so this includes rent as well. And that's the 50. So rental revenue is the 50 that I need to eliminate as well. Okay. So I'm going to make sure that I incorporate these two in my analysis. Now, during year 6, sales made to M totaling 90. So do you know what? Before I read this, let me highlight that in my analysis. So first of all, let's analyze the acquisition differential. So analyze the AD. And in this case, we didn't have to do a purchase price analysis because basically they've done it for us. So we know that the AD is related to building. And as we said, it was 25,000 divided by 20 years gives us 1250. And when was this purchase? This was on January 1st. Now, I don't really care about how much of my AD I've already amortized because I'm not doing a statement of retained earnings. I'm only doing the current year's income statement. So I know I've got to incorporate 1250 here. We're going to label that as A. Now, again, the second step is I want to list all intercompany transactions so that I can eliminate it in both revenue and expenses. The first one is interest, right? And interest, revenue, and expenses we know was 100,000 times 12% times 1/2 because it was only till from July 1st. So that's 6,000. Let's label that B. Rental was the other one. Rental income, again, revenue and expenses. I have to make sure I eliminate that. And that was for 50,000 that was given to us. Let's call that C. Now, let's read the next set of lines here. It says, during the year 6, K made sales to M totaling 90. So we know this is the intercompany sales. So intercompany sales, so sales and purchases will have to be eliminated at 90. Let's call that D because we're going to make that reference, isn't it? Now it says that on December year 6, this is the ending inventory, inventories of M contain. So that means if inventory of M contain, that means it must be K selling. So ending inventory, K selling, how much? Unrealized profit of $5,000. So this is already the profit. Okay. Now on January 1st, inventories of M contain. So if it's M on M's books, it must be K selling as well. So this is beginning inventory, K selling. And how much? It was 12,000. Okay, so let's analyze the inventory. So again, intercompany profits is the third step. So I like to use a 3-column approach. I've got before tax, 40% tax, and after tax. You can see now, after doing multiple analyses like this, you see how powerful and important the 3-column approach is. So let's analyze the beginning inventory, and this is K selling. And so that means the sub-selling. So this is upstream sale. It's 5,000 profits. And then the ending inventory, K selling as well. And that one was for 12,000. And again, let's do the after tax here. So 4,800. Sorry, this one's 2,000. This is 3,000. And this is 4,800. And this is 7,200. So let's label this one F and the 3,000 G. Okay. Don't worry about why I'm putting different letters here. I wanted to make sure that I can relate it back to the analysis to show you where I got my numbers. Now, let's read further. It says on January 1st, year 4, so this would have been 2 years ago, they sold machinery to K. So M sold to K. So M selling and recorded a profit of 13. The remaining useful life of that profit is 5 years, and assume straight line. Okay. All right. You know what? I kind of missed. So let's deal with that one. I missed this one actually. So let's deal with that one first. So that is called a depreciable profit sale. So let's look at a little bit of the theory. So first of all, when we're selling, when we're exchanging and selling intercompany assets within the related group, what we have to do is we have to eliminate the intercompany gain or losses on that depreciable property. And by doing that, we're essentially restating the asset at its original cost. Now, remember, if let's say company A sold an asset to company B, and this is the parent and the sub, and let's say they sold the asset, net book value is 10, they sold it for $100, then you'll see that the profit of 90 needs to be eliminated. We need to eliminate that profit of 90. Now, what happens is the purchaser, the buyer, is going to amortize that equipment at the new cost of 100. But the fact that you're eliminating that 90,000 means that we're also going to restate the depreciation based on the original cost, original term, original depreciation. So let's say the depreciation of this asset is, let's say, $2 a year. Then we're going to have to make sure that we bring the amortization from $10, let's say it's 10 years, to $2. Okay, or sorry, from 10 years, let's say there's remaining life for 10 years. So we're going to reduce the amortization from, let's say 100 divided by 10 is $10 to $1 because there's 10 years remaining life. Now, that means that the cumulative depreciation needs to be restated as well based on original terms. So remember, this is the date of acquisition. So every year, as the subsidiary amortizes asset at $10 per year, we're going to have to constantly adjust. But we're going to remember that our adjustment, again, gets accumulated and needs to be accumulated because of the amount of amortization that the buyer would have already taken on that new asset. The retained earnings is also adjusted by the related accumulative effect. So let's take a look at the T account, for example. So the T account in the investment subsidiary, if you remember this T account, we started with original cost. This is what we paid. This is the income earned, so we pick up our share of the net income of the subsidiary, less our share of the dividends received. We know that the acquisition differential amortization has to be adjusted, and this is part of, I guess this is part of the equity and earnings pickup, right? So if you're using the equity method, this amount would have been your investment income. And this is equity method, by the way. Now, I want you to check out these two things. So remember that sale of asset? Well, that sale of asset resulted in a gain. So that sale of asset to, let's say, from P to S, from parent to sub, results in a gain. And that gain, we're going to unrealize that gain. So remember, that gain may have been in this income. So we're going to take that away. We're going to reduce it because we're going to remain unrealized. But you'll see that as the asset gets amortized, as the asset gets older and we need to start taking amortization, we're going to effectively reduce the amount of unrealized gain based on the amount of additional amortization that the subsidiary or the buyer of that equipment would have taken. So over time, this too will go to zero as the asset depreciates, as matures to, as the asset matures to zero, the net book value will be zero, and this number will equal the unrealized gain. Now, looking at the consolidated retained earnings, you'll see that we have the parent's retained earnings. We know that we pick up our share of the subs, of the parent's subs portion of retained earnings since acquisition. Remember, that's an important point. And remember, we're going to take the AD as well, because the AD is important because that adjusts the actual profit that we pick up. But here's the other side of the entry. The accumulative amortization, the unrealized gain gets unrealized, but again, it gets realized by increasing the accumulative amortization. It's going to effectively realize part of that gain, and then hopefully at the end of the maturity of that asset, these two amounts will equal. So that's essentially what we need to do. So going back to the question, we're going to have to determine that there was a gain on sale for machinery, and that gain, and who sold it? And it says here that who sold it? It was M. So M selling. And M selling, there was $13,000 of profit, and the remaining 5 years is $2,600 profit. Okay, so the fact that this, in this case, K would have recognized a higher amortization. How much of that higher amortization it would have recognized? It would have been the amount of profit over the next 5 years, amortized over the next 5 years. That's the amount of incremental depreciation that we need to adjust. The tax effect is 1040, net of tax is 1560. Let's label that as H. Okay, and now I've forgotten to actually put this in there. It says M sold land to K with a profit of 10. So this is the land, and this is the equipment, machinery. So that one is the land sale. And it says K held the land until October 6th when it was sold to an unrelated party. So let's take a look at the theory behind it. So in going to your lecture notes, you'll see that when there is a sale of land, and land is representative of an asset that's non-depreciable, you'll see that at the date of sale, within the related group, you need to defer the gain. So we need to debit the gain and credit the asset. Why? Because we want to bring the asset back to its historical cost, because that sale does not exist. Now, each year, as the asset remains within the consolidated group, that asset will have to be adjusted. That asset will have to constantly be adjusted. But this time, we're going to actually adjust the retained earnings. You're going to remember, whoever sold it, the gain would have been reflected on their retained earnings. So they would have actually recognized it or realized it at the legal entity. Now, what happens in this case is that we're going to actually realize this because now we sold it to a third party. And that's essentially what we're going to do next. So, and of course, all of this has to be net of tax effect, right? So this is the land. So let's put that down. This is the land. And this is a gain on land. And who was selling to whom? It was M selling, wasn't it? Now the realized gain, because it was finally sold to an outside party, and that gain was $10,000. And the tax is $4,000 and $6,000. Let's label that E. Now, I forgot, you probably have seen this already, the tax is 40%. That's why I used the 40% column here. Okay, so now that I've analyzed all of the intercompany transactions, I'm going to calculate the consolidated income. Now, before I do that, I want to figure out what the non-controlling interest income statement is. Okay, so I need that for the consolidated statement, because remember, the consolidated income I have to disclose and I have to label how much of that consolidated net income is attributable to controlling and non-controlling interest. So let's start the analysis. So it's income of K, because K is the subsidiary. And what was the income? It was $25,500. I want to look at, first of all, I need to incorporate the acquisition differential. Okay, the 1250. So I'm going to amortization of AD. I'm going to label that 1250 A. I'm going to subtract it because I need to, I'm amortizing the AD. Next, I want to look at any profits that K would have recognized. So in this case, we have beginning inventory, K selling, 3,000. That's going to be right. And then the ending inventory, K selling. Okay? So I'm going to add the beginning profit, and that was 72. Give me 1 second. Sorry, I just want to double check my work here. It says, December 31st, year 6, M contains profit of 5. Oh, I got this backwards. This is ending inventory, and this is beginning inventory. Sorry. Ending inventory, beginning inventory. Okay, that's why it doesn't make sense. All right, so I need to go beginning inventory profit realized, and beginning inventory, that's 7,200. I need to add, label that as F, and I'm going to have ending inventory profit unrealized. Remember, these are K selling, and that would be 3,000 minus, I'm going to label that G. Okay. Now, what else? Were there any of these? So these were M selling, so I don't have to worry about that. So I'm going to add all this up, and I should get this plus 7,200 minus these two should be 28,450. This is the adjusted profit. Times, how much do we own? We own 80, so the non-controlling interest is 20%. So this is 5690 NCI. Okay, so now we're going to actually do the consolidated statement. So it's M Company, consolidated income statement for the year ended, year 6. Let's start with revenue or sales. So we're going to start with M Company and then with K, so 600 plus 350. And remember, we listed the intercompany sales, right, of 90. So we're going to take away the 90. That's letter D. And that gives us 860. Interest revenue was 6,700. And we're going to take away the 6,000. And that's 700. Gain on sale. Okay, so the gain on sale, it was 8,000. So 0 plus 8. Now, we're going to recognize the gain on sale of 10,000. So we're going to recognize that finally because we sold it. So I'm going to add a 10 in here. Label that as E. And that's 18,000. Now, in the question, there was a gain on sale of land, but again, they would have sold, so K, remember, that gain on sale was M selling to K, and K would have recognized that finally to a related party. So the real gain, the true gain, if I was to incorporate the gain that was deferred from the sale from M to K and then K eventually the third party, it's actually 18. 18,000 really was the true gain in, from the cost less the actual sale to a third party. Okay, so that's 878, 700. Cost of goods sold. So let me just word that for COGS, COG. And that again, let's take the cost of goods sold of M is 334 plus K, it's 225. Now, we're going to adjust the beginning and ending, correct? So the beginning, we're going to realize that. So we're going to take that 12, we're going to, realizing it. And then the ending inventory, we're going to unrealize that, okay? So we're going to take, so first we're going to take away the 90. Then we're going to adjust for the inventory. So we're going to subtract 12 plus the 5 and that gives us 462. What about distribution? So we're going to add both M and K. Now remember in the question it says it includes amortization expense. So we know that the acquisition AD we need to incorporate in there. And the equipment. Remember, the amortization, we need to adjust for the equipment. We need to adjust down the equipment. So the amortization. So we're going to subtract 2,600 because we've taken too much depreciation. Okay, and we're going to call it letter H. And then we're going to add the AD, letter A. The admin expenses, again, starting with M and K, and remember we've got interest here, right? Revenue and expenses 6,000, so we're going to subtract 6 from there. Gives us 1,700. income tax expense, again, M and K. So, land is finally realized. So we need to add the 4,000. Okay. We're going to also add the amount of gain that's realized. We need to realize that gain to offset the higher amortization. And what about the beginning ending inventories? Well, first, the beginning inventory, the 4,800, we're going to add because now we're going to realize that, right? The beginning inventory is now sold. Now we need to add back the taxes on that. And we're going to subtract the 2,000, the ending inventory. So you've got to show this calculation so that when it comes to assessment, we know exactly how you came up with your numbers. Altogether, the expense is 819,390. And the profit, the consolidated profit, is the difference between these two, which is 59,310. Now, we already know that we already calculated non-controlling interest, didn't we? We already did that calculation. And that calculation gave us 5,690. And shareholders of M would be the difference between the two. That's 53, sorry. Okay? So that's essentially how we do the consolidation. Thank you.